Welcome back to another video, and today we're going to be talking about Trading 2 on 2. And if you're new to Trading 2 on 2 or have been on Trading 2 on 2 for a while, it might be a helpful video for you guys to see, because I have made this mistake, and I've also made this mistake while holding a Trading 2 on 2 account for the last, I think it was like, there was a year or so where I just didn't know about or understand this whole thing. So definitely stay tuned and watch the video, and you'll get hopefully some tips to take away from this video. Before I get into the video, if you want a free fractional share worth up to £100, then click the link in the description or use code BEN and you'll get a free fractional share worth up to £100. So the biggest thing I want to talk to you about, and this is the biggest mistake I actually kind of made when I invested, to be honest with you, and started out. I started using the invest column, and the invest column is, well, there's nothing wrong with the invest column, but the problem is you're investing into something where you might as well just go in the stocks and shares ISA and have tax-free benefits. So you can end up paying no capital gains, no dividends tax, and all you've got to do is just put the money in the stocks and shares ISA and sign up. Obviously make sure you don't have another stocks and shares ISA. This is the only one you can have. But yeah, instead of putting money into the invest account, just put it in the stocks and shares ISA. The invest account should be something you consider once you've maxed out your ISA every year, which is £20,000. So you can only put £20,000 deposit in each year. And I say only, £20,000 investing a year is incredible. Like, if you can max that out, that's really impressive, and you're going to be on your way to a very good future, in my opinion, by investing for that amount of period of time. Obviously, stocks and shares does come with a risk. Investing does come with a risk. But if you can pick the right ones, then there we go. And that's something I also want to talk to you about and lead on to, is the biggest thing I made, like a big mistake I did personally make when I started out, was not understanding valuations and just going into the stock market going, oh, and just looking at the graph. So let's say let's actually show you an example. So let's say Palantir, because in 2021 this is one of the stocks I was buying as well. For a start, I liked the company. That was something I wasn't too bad at. I would try and make sure I could understand a company or look at the direction that it was going in the sense of what the fundamentals were, in the sense of, like, for instance, this Palantir was a company that was to do with data, to just summarize it. And I believed with some of the products they're using, they're in the government sector, and the other products that they've got, like Gotham, Foundry, I thought, well, they could end up becoming a software company that a lot of other companies will use, or a lot of industries that use. And we're starting to find out that a lot of different industries are using Palantir. But this is something I was thinking about and thinking in the future. And I even still think now, like, there's so many companies that they can attract and get. I just think pretty much any company would use Palantir at this point. But anyway, rambling on. But Palantir, at the time, I was like, oh, it's gone to $33. So when it went to $33 and then it dropped all the way down to $23, $26 at the time, I was thinking, great time to buy in. But when it was $36, and when it was $25, when it was $20, when it was $15, it were all just stupidly expensive pricing. Like, it shouldn't have been that price. It was so expensive. And that was because the PE ratio was ridiculous. Like, they weren't earning any money at the time. They didn't deserve to be anywhere near 36 or 20 or 25. And then, as you can see in the graph, it went all the way down to 7, where it was probably fairly valued, or valued well at the time, because of the potential of what it could have been. That's where it should have, and that's where I should have been buying, really. And that's when I started to understand PE ratio. Then when it was $6, the PE ratio would have been very, very low. It would have been low at $6 or $7. So that's why it went up in price, and it then went to 15, and then it went to 20. So it started to have a PE ratio of, let's say, 50 or 30. And a growth stock normally has a PE ratio of about 30, 40. But then a massive growth stock, you can argue, do trade between 60 and 80. And sometimes 100. That's where valuations start to become a bit mad, because you can end up getting like companies like Palantir, for example, that are trading at a 423p ratio. And yes, that is a lot. That they are way overvalued, by the way. So yeah, but this is a long-term hold. And my point is even though I got in at these expensive valuations, I was buying down at the dips, even at $10 to $9. So I was averaging in, I was constantly buying. And then obviously that massive all-time high of 36 in 2021 looks like a cheap price when it was $125 at one point. Doesn't show, but $125 it went to. And now it's $84. So timing the market is better than timing the market, but you can help yourself by knowing if something's just ridiculously overvalued or not, that you can wait for yourself to buy in cheaper. Another one of my stocks that I believe will do well, and at the moment I'm pretty much break even, is SoFi, and their P ratio is 27, which I think is fairly valued. I think that's just what it should be valued at. If not, maybe could go 30, 35p ratio, but I think at the moment it's fine. But once they start earning more than what they're saying, so for example, so let's just make it easier. So their earnings per share is 46. So let's just make it easier and say 50. So once they double and make $1 a share, then their share price will be about, well, their P ratio at this current price would be 15 roughly. That's the thing. And then 15 would be really cheap. It should be, when you're growing, you're looking at, like I say, some trade at 60 to 80p ratio. So if their price to earnings is 15, then they should be commanding at least 30, at least. So this would be about $26, $27 stock at a 30p ratio roughly, if it was earning $1 a share. So that's why your earnings, you've got to keep an eye on the earnings and see what their growth is and what they're guiding. So that's just something I would look into. I'd also look at market caps, because you can also look into the industry and see what's the highest company, what's commanding the biggest market cap in that sector, and then you can see kind of the roof or the potential of what that company could become, or could get a sector of, like a bit of a percentage of that market capitalization. And because a lot of people also make the mistake of like seeing a stock that's like $500 a share and thinking it's like crazy and expensive, and you've just found a stock that's literally $2 and there could be potential of going to 500, which yes, obviously it could, but there's a lot of factors that come into things, such as like the amount of shares that are outstanding. The one that's $500 a share could end up being a lot cheaper than the one that's looking at like showing $2 a share. The one that's got $2 a share might just have ridiculous amounts of shares outstanding, and the market cap might be way higher. So also just look into stuff like that. So research on YouTube on market caps, shares outstanding. So that's something I would really recommend as well. Obviously this was just a video that was come to my head, and just thought I would film and just share with you something that mistakes that I know people do make, and also I've made in the past. For instance, especially the ISA, stocks and shares ISA, and that's something I really messed up on and should have got in a lot earlier, but that's what I want to tell you guys now. Anyway, thanks for watching. Please subscribe if you're new, give this video a like, and also free fractional share worth up to £100, link in the description, and we'll use code BEN.